For many retirees, the biggest long-term risk to their retirement plan isn't necessarily the market, it's taxes. Not because tax rates suddenly spike overnight, but because taxes compound quietly over time. When you shift from earning income to withdrawing income, the rules change. During your working years, you're focused on accumulation. In retirement, you're living in distribution mode, and distribution has tax consequences. Retirement isn't just about how much you've saved. It's about how that income will be taxed year after year. Most retirement accounts, like traditional 401ks and IRAs, are tax deferred. That means the money inside hasn't been taxed yet. If someone retires with $1.5 million in a traditional 401k, that number looks like their money, but it's really a gross number, not a net number. Every withdrawal is taxed as ordinary income, so the actual spendable amount depends on future tax rates and income levels. That doesn't make tax-deferred accounts bad, but it does mean that balance isn't entirely yours, at least not yet. The real issue isn't the account, it's concentration. If 80% or 90% of your retirement assets are tax-deferred, then most of your future income will be taxable. Over a 20 to 30-year retirement, that concentration can create sustained tax exposure. You may not notice it in the first few years, but as withdrawals increase, especially when required minimum distributions begin, the tax impact can grow. That gradual buildup is what I mean by a retirement tax time bomb. It's not dramatic, it's steady. At a certain age, the IRS requires you to begin taking required minimum distributions, often called RMDs. These withdrawals are calculated based on your account balance and IRS life expectancy tables. They are not optional, and they are fully taxable as ordinary income. Even if you don't need the income, you must take it. That's when flexibility starts to narrow. The issue with RMDs isn't just the tax bill, it's what the income does to everything else. Let's say someone is required to withdraw $50,000 in a given year. That $50,000 gets added to Social Security, pensions, and other income. That stacking can push someone into a higher tax bracket, increase how much of their Social Security becomes taxable, trigger higher Medicare premiums. It's not one isolated event, it's a ripple effect. Medicare premiums are income-based. If your income crosses certain thresholds, your premiums increase under what's called IRMAA. That means a large withdrawal one year can increase healthcare costs the following year. Many retirees don't connect retirement withdrawals to Medicare premiums, but income thresholds matter. Even small increases in income can have unintended effects. Many people assume Social Security is tax-free. In reality, up to 85% of your benefit can become taxable depending on total income. That calculation includes IRA withdrawals, pension income, and certain investment income. So two retirees with identical Social Security benefits could owe very different amounts in taxes. It's not the benefit itself that changes, it's the income around it. Retirement income isn't just about how much you have saved, it's about how income is structured and sequenced. Drawing income from a taxable brokerage account creates different tax consequences than drawing from a traditional IRA. Drawing from a Roth IRA creates different consequences entirely. Structure matters, sequence matters, coordination matters. In retirement, there are generally three tax buckets: tax-deferred accounts, tax-free accounts like Roth IRAs, taxable brokerage accounts. Each bucket follows different tax rules. If all your income comes from one bucket, flexibility is limited. But if income can be pulled strategically from multiple buckets, it may allow better control over taxable income in certain years. That flexibility can matter over decades. A Roth conversion means voluntarily paying tax today in exchange for potential tax-free growth later. It's not right for everyone, but certain lower income years, especially between retirement and RMD age, may create planning opportunities. The goal isn't to avoid taxes entirely, it's to manage when they're paid. Timing can be just as important as rate. When one spouse passes away, the surviving spouse typically shifts from married filing jointly to single filing status. Income may not change significantly, but tax brackets do. That means the same income could be taxed at higher rates. This is sometimes referred to as the widow's penalty. It's one of the least discussed but most impactful retirement tax issues. Most families won't owe federal estate tax, but inherited retirement accounts are generally taxable to beneficiaries when withdrawn. Under current rules, many heirs must withdraw inherited IRA funds within 10 years. If those heirs are in peak earning years, the tax impact can be significant. Retirement tax planning often extends beyond your lifetime.